Accrual accounting records what a company earned on paper, but it doesn't always reflect the physical cash hitting the bank account. Without a closer look, that paper profit often vanishes when you try to use it. To find the firm's actual cash position, we use the direct method to calculate cash flow from operations, or CFO. We'll break this down into 5 distinct steps. To perform this conversion, you will need 2 documents: the current income statement and a comparative balance sheet showing the changes from the previous year. By bridging the gap between income statement performance and balance sheet changes, we can see if the company's daily operations actually generate the cash needed to stay afloat. This table from the CFA curriculum outlines the formal direct method. It requires 5 specific components: cash collections, cash inputs, operating expenses, interest, and taxes. Step 1 converts total sales into actual cash collections. We calculate this by pairing total sales from the income statement with the change in accounts receivable on the balance sheet. If accounts receivable increases, it means customers have not yet paid for the goods they received. Because that cash hasn't arrived, the increase must be subtracted from sales to find the true collection figure. Next, we pivot from money coming in to money paid out. Step 2 calculates cash inputs, the actual cash sent to suppliers for inventory. Start with cost of goods sold. If the company's inventory levels rose, they spent cash to build that stockpile. We add any increase in inventory to our cash outflow. However, if the company's accounts payable increased, they are essentially using supplier credit instead of cash. We subtract that increase, as delaying payment acts as a temporary cash savings. Top-line revenue and baseline costs are just starting points. Adjusting for working capital changes reveals the exact cash drain from operations. Cautious. Step 3 determines cash operating expenses. This metric requires careful filtering to remove items that don't involve actual bank transfers. Operating expenses include non-cash charges like depreciation and amortization. These are accounting entries, not cash payments, so they must be removed from the calculation. Strip out depreciation from your total operating expenses before you look at any other balance sheet adjustments. Now we check the balance sheet. A rise in prepaid expenses represents advance cash spent for future benefits, so we increase our cash outflow calculation. If accrued liabilities rise, the company has recognized an expense but kept the cash. We decrease our outflow calculation because that cash has not actually left the building. The logic for these adjustments is consistent. An asset increase is a cash outflow, while a liability increase is a cash inflow. Systematically neutralizing these timing differences and non-cash items prevents an analyst from mistaking paper expenses for actual cash movements. Step 4 focuses on the firm's mandatory external obligations: cash interest and cash taxes. We take the interest expense from the income statement and reconcile it with the change in interest payable to find the actual cash paid to lenders. We use the same process for taxes. Adjust the tax expense by the change in taxes payable to reveal the actual cash sent to the government. In Step 5, we bring all these isolated cash movements together to find the net result. Take your cash collections and subtract the 4 outflows we calculated: cash inputs, cash operating expenses, cash interest, and cash taxes. This final total reveals whether the company's internal operations are self-sustaining or if they require external debt or equity to stay in business. This total represents the final cash flow from operations figure for the period. You now have a clear view of the company's cash health, independent of the assumptions used in accrual accounting. This detailed look at individual cash drivers is much more granular than the indirect method, which is the macro-level reconciliation most companies provide. To fully master financial analysis, you need to be able to work from both directions.